Every single day, financial feeds are flooded with a relentless stream of news regarding massive mergers and acquisitions. We see Japanese trading houses making high-profile moves, like Mitsubishi spending over £1 trillion on U.S. natural gas, or Itochu taking full control of apparel brands like Descente. Retail investors often react to this volume by relying on simple checklists. They check stop-loss triggers or categorize these firms into basic resource versus non-resource buckets. Treating these entities as standard theme stocks that rise and fall with commodity cycles is a structural miscalculation. Many still picture the Sogo Shosha of the past, middlemen brokering import and export deals over the telephone. To accurately evaluate their behavior today, professional analysts discard those retail checklists in favor of a rigid structural portfolio model. These companies operate on a completely different time horizon. They are continuous portfolio management entities. A modern Sogo Shosha acts as a highly disciplined capital allocator, actively integrating and shaping global physical supply chains. This structural depth, not the daily market noise, is exactly what attracts elite institutional capital and legendary long-term investors. Understanding their acquisition strategy requires mapping a specific three-layered architectural model. We construct this causal loop, test it on the ground, and prove it with quantitative data. Analyzing this structural architecture provides a framework to separate strategic signals from market noise. The foundation of this model is the value chain layer. A firm's direct involvement across multiple physical industries, from resource extraction to retail distribution, establishes its structural baseline. Directly above this sits the cash flow layer, driven by the outputs of that physical network. These layers are causally linked. If the value chain becomes highly dependent on a single physical market, the resulting cash flows synchronize. When segment returns move in tandem, the financial stabilization effects of a diversified portfolio collapse. If multiple segments contract at the same time, overall cash flow volatility increases. A trading company's vulnerability lies in the mathematical correlation embedded across its physical value chain, rather than the isolated price drop of a single commodity. The final component is the capital allocation layer, which closes the system into a continuous feedback loop. The correlation structure of the cash flow directly restricts how flexibly a firm can deploy capital. When cash flow contracts across correlated segments, investment capacity shrinks, immediately choking the velocity of asset rotation and new acquisitions. This creates a testable dynamic. Periods of rising segment correlation inevitably force a decline in investment and divestment velocity. Individual M&A announcements are the visible outputs of this internal recycling loop adapting to correlation pressures. We can test this abstract model by observing physical shifts in the machinery and factory automation sector. Traditionally, the supply chain in factory automation operated sequentially, from the manufacturer through the Sogo Shosha to the end user. The trading company secured its position by providing overseas sales channels, absorbing inventory financing risks, and integrating complex project installations. Now, industrial value is migrating away from initial hardware sales and toward predictive maintenance. Data streams directly from the end user back to the manufacturer. Industrial machinery acts as a continuous, data-generating operating asset. The flow of this operational data is rewriting the traditional power dynamics of the entire supply chain. Sogo Shosha must capture this data flow, or they face structural obsolescence in the factory automation value chain. Trading companies find themselves evolving into direct competitors with manufacturers over data ownership. Without direct access to that operational data, the trading company node is entirely bypassed. Sogo Shosha use acquisitions to capture user touchpoints, rather than focusing purely on quarterly revenue targets. M&A in factory automation allows these firms to secure raw operational data streams. These acquisitions represent a defensive maneuver to protect the firm's position in the capital allocation loop. We can cross-reference this operational reality against unified quantitative proof across the top 5 firms. This table aggregates the key performance indicators for Mitsubishi, Mitsui, Itochu, Sumitomo, and Marubeni. By isolating the operating cash flow and comparing it against the investing cash flow over a trailing 3-year period, a pattern emerges. Across all 5 firms, cumulative investing cash flow significantly exceeds operating cash flow. Normal business operations alone cannot fund their current growth and acquisition cycles. This requires continuous asset recycling, the systematic divestment of mature assets to fund new acquisitions. The quantitative data confirms that Sogo Shosha are designed to rotate assets, rather than merely accumulate and hold them indefinitely. Returning to the table, we look specifically at the goodwill to equity ratio. Itochu operates with a relatively low goodwill ratio, standing at approximately 15%. Mitsubishi contrasts sharply with this, carrying a much higher ratio of approximately 35%. This divergence signals distinct approaches. Itochu executes a high-rotation, lower-risk philosophy, while Mitsubishi deploys a heavy investment, growth-oriented strategy. These precise financial metrics expose deeply embedded capital allocation philosophies that retail market noise obscures. The financial data acts as the engine for the architectural model. Evaluating a single merger announcement as an isolated buy or sell signal misreads the structure of the firm. Acquisitions are the visible outputs of a necessary cycle, sensing new opportunities, rotating out of mature assets, and actively transforming the portfolio. Evaluating a Sogo Shosha requires tracking the structural changes in portfolio correlation and asset recycling rates over time. True institutional analysis demands looking past the daily news cycle to master the causal relationships governing value chain integration, cash flow, and disciplined capital allocation.